Welcome to What's the Deal, our investment banking podcast on Making Sense, the hub for jpmorgan corporate and investment bank podcasts. In each episode of What's the Deal, we'll explore the trends that are driving deal-making and transforming industries today.
Hello, and welcome to What's the Deal. I'm your host today, Kathleen Darling from jpmorgan's Debt Capital Markets team. Continuing on our conversation that we've started in regards to the debt capital markets to date, here with me is Brian Tramontozzi, head of North American Leveraged Finance Capital Markets, to discuss the latest trends we are now seeing in the high-yield market. Let's get started. Brian, thanks for being here.
Oh, it's great to be back.
Pivoting from the leveraged loan to high-yield market, can you start by giving us an update on what activity you are seeing year to date?
Sure. Well, in 2022, high-yield primary activity started out strongly, but slowed midway through the first quarter following the outbreak of the Russia-Ukraine geopolitical conflict and rising rates. By this same time last year, the market only priced $55 billion of bonds, 44% of which priced in January. During the remainder of 2022, only another $42 billion priced. That made 2022 the slowest high-yield market year since 2008. To start 2023, the high-yield market has seen $70 billion in primary issuance, up 27% from the same time last year. Amidst a volatile economic backdrop, we continue to see a favorable market technical. Account balances remain robust. We have approximately 4% cash on balance. As for price performance, in the first 5.5 months of 2022, the JPMorgan Global High Yield Index increased almost 3.5 percentage points, from 5.13 to 8.6. By comparison, year-to-date 2023, the high yield index is 20 basis points lower to 9.43%. Interday price volatility is also abated. For example, the JPMorgan index has remained within a 30 basis point range since the end of March. Stability like that helps to moderate new issue premiums.
And in terms of issuers coming to market, is the catalyst still refinancings, or have you begun to see more opportunistic trades?
Amidst broader rate volatility, a majority of the high yield primary activity this year has been refinancing related. Year to date, of the $70 billion that I mentioned before, approximately 2/3 has been refinancing oriented. That compares to refinancings comprising less than half of last year's $97 billion of total volumes. But to be clear, the market remains open for opportunistic transactions, and we have seen debut issuers also coming to market. But refinancing is where we're seeing most of the activity.
At the back half of 2022, high-quality names were in the highest demand. Is this still the case, or are you seeing demand across all ratings and credit profiles?
In times of economic stress, investors naturally migrate toward defensive credits and higher-rated issuers. In the beginning of 2022, the spread between the CCC and BB index was 450 basis points. Today, that's over 800 basis points. In October of last year, that spread was over 1,000 basis points. Now, I should note that less than 10% of the index comprises CCC-rated deals, whereas BBs make up 42% of the index. Single B issues are holding comparatively tight versus BBs. The average spread between those rating categories was 150 basis points in the beginning of 22. It's just over 200 basis points today and was over 230 basis points at the peak last year. In the back half of 2022, about 38% of volume of the primary issuance market was BB rated. That number remains consistent with what we're seeing in 2023.
And finally, a looming recession remains top of mind for companies and consumers alike. Are you seeing the high-yield market price in a recession?
So spreads in the high-yield market are currently in line with non-recessionary levels, demonstrating the continued strength of the market and reason for issuers to consider going now. Current and forecasted default rates remain modest. We're currently at about 2.2% for high yield, and the projection is 3% by year end. Also, the robust technical backdrop has promoted a recent resurgence in primary activity. Outflows for high-yield bond funds year-to-date are 1/3 of what we experienced last year. Cash balances are currently around 4%, which implies between $70 and $80 billion of market liquidity. Finally, the high-yield market generates about $12 billion a month in coupons. So technicals are excellent, and I believe are helping keep spreads to non-recessionary levels in the face of the challenges facing the high-yield market, namely elevated recession risk, debt ceiling negotiations, and inflation. If the economic environment deteriorates, we would expect spreads to rise, in which case issuers that access the market today will benefit.
Brian, thank you for the conversation. This has been a comprehensive overview of the debt capital markets activity year to date. It's been a pleasure having you.
Once again, it was a thrill being here.
Thanks for listening to What's the Deal? If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. To stay ahead of the curve, sign up for JP Morgan's In Context newsletter, packed full of market views and expert insights delivered straight to you. To subscribe, just visit jpmorgan.com/in-context. This material was prepared by the investment banking group of JP Morgan Securities LLC and not the firm's research department. It is for informational purposes only and is not intended as an offer or solicitation for the purchase, sale, or tender of any financial instrument.